All right, let's talk about something that can completely change your investment game. We're diving into what we're calling the Elite Investor's Roadmap. This isn't just about tweaking your portfolio, it's about adopting a whole new way of thinking, the exact blueprint the top 1% use. So let's get right into it. So here's a question you've probably asked yourself. Why is it that the vast majority of people, maybe even you, who invest in mutual funds just end up with, well, average results? You feel like you're doing all the right things, but the needle just doesn't move. It's frustrating, right? But believe me, there's a very clear reason why this happens. And here it is. It's because the top 1% aren't just playing the same game better. No way. They're playing a completely different game altogether. They've got a different rule book, a different strategy, and they use a completely different set of tools. And that's exactly what we're going to unpack today. To really get this, we first need to understand what some call the investor's great divide. This is the massive gap that separates most investors from the truly elite. And spoiler alert, it has almost nothing to do with how much money they have. It's all about their approach. This slide really just lays it all out. On one hand, you've got the average investor. They act like a passive consumer, right? They see a fund that did well last year or hear about a popular trend, and they follow the crowd. The elite investor, a totally different mindset. They are an active evaluator. They don't follow the crowd, they follow the data, digging deep into the managers and their strategies. So how do they do it? Well, this whole elite approach really boils down to three huge mindset shifts. You can think of them as three revolutions that form the foundation of everything they do. A revolution in metrics, in strategy, and in systems. Let's break those down real quick. First, the metric transformation. This is all about looking at the right numbers, the data most people completely ignore. Second, the strategy shift. This is where you stop thinking like a customer picking products and start thinking like a CEO hiring top talent. And third, system architecture. This is where you build it all into a smart, automated process. Okay, let's dive into that first revolution, metrics. You know, most people just glance at the one-year return and call it a day. But the pros? They're looking at a whole dashboard of advanced tools to see what's really going on under the hood of a fund. First on that dashboard is the Sortino ratio. Now this one is absolutely brilliant. Why? Because unlike other metrics, it only dings a fund for bad volatility. You know, the kind that actually loses you money. It completely ignores the good kind of volatility, the upward swings. This gives you a way clearer picture of a fund's real risk-adjusted performance. And here's the magic number you need to know. The pros are looking for a Sortino ratio of over 1.5. If they see that, it's a huge green flag. It tells them that the manager is fantastic at getting solid returns without taking stupid risks. Next up, the downside capture ratio. You should think of this as the ultimate stress test for a fund. When the market inevitably tanks, what does the fund manager do? Do they protect your money or do they just go down with the ship? This number tells you exactly that. And the elite benchmark to look for here is less than 90%. What does that mean? Well, if the market drops by, say, 10%, a fund with this ratio will drop by less than 9%. That's a concrete sign of a manager who knows how to play defense. And finally, we have Jensen's Alpha. This one is pretty much the holy grail of metrics. What it does is it strips out all the noise from the market's general movement and tells you exactly how much extra return was generated purely by the manager's skill. It's how you separate real talent from just being lucky. Now, here's something that might surprise you. You're actually not looking for some ridiculously high alpha. The sweet spot for real, sustainable skill is somewhere in the 2 to 4% range per year. Anything higher than that is often a sign of a lucky streak that's probably not going to last. Okay, so now that we have the right tools, the right metrics, what do we do with them? This is where we get into the actual strategies, because once you have this data, you can start making moves that the average investor has never even heard of. Let's just touch on two really powerful ones. First is multi-factor investing. This isn't just about picking one good fund. It's about building a team of funds that have different strengths that don't move together, like value and momentum. So when one is having a rough patch, the other's likely doing well. They balance each other out. Then there's contrarian investing. This is all about discipline. It's the art of buying really high-quality funds when everyone else is panicking and selling them off, getting in at a discount right before they turn around. And that brings us to the final revolution, building your system. This is the crucial part where you take all this knowledge, all the metrics and strategies, and you build it into a repeatable, almost automated process. You're essentially building your own personal wealth-generating machine. This chart gives you a peek into how a professional scoring model works. And just look at what gets the most weight. It's fund quality at 30%. That's all those metrics we just talked about. This shows you the system isn't about chasing last year's winners. It's a methodical process that prioritizes quality, manager skill, valuation, and risk. And this is how that system translates into an actual portfolio. It's not just one big pile of stocks. It's a very deliberate three-basket structure. You've got your core basket for steady, consistent returns. You have a smaller growth basket for that extra punch. And then you have a hedge basket, a small slice, designed purely to protect you when the market goes crazy. It's built to perform well no matter what the market throws at you. So, we've gone through the metrics, the strategies, the systems. The big question is, what's the actual payoff? What does this all mean for your bank account in the long run? Well, the difference is, honestly, it's staggering. Just look at this chart. It says it all. You start with the same 10 lakh rupees. After 20 years, the average investor's portfolio grows to about 67 lakhs. Not bad. But the elite investor, using this exact roadmap, their portfolio grows to 135 lakhs. That is literally more than double the money from the exact same starting point. And what's driving that incredible difference? It's a tiny, almost unnoticeable edge. Just a 3% difference in average annual returns. That's it. That's the power of a superior process. And over a lifetime of investing, that tiny little 3% edge compounds into a result that can change your life. We're talking about doubling the wealth. It really is the difference between a comfortable retirement and true financial freedom. So, if you remember only one thing from this entire explainer, please let it be this quote. This is the core shift. Stop thinking of yourself as a consumer picking funds off a shelf. Start thinking of yourself as the CEO of your own family's wealth. And your most important job is to go out and hire the absolute best, most skilled managers to work for you. That simple change in perspective, that's the key to the entire Elite Investors Roadmap.